Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Steve Saretsky. He's a Vancouver-based realtor online at SteveSaretsky.com. Welcome back to the show, Steve.
Yeah, thanks for having me on. Always a pleasure.
Steve, is April shaping up to be a better month for home sales than in March?
So far, it's pretty much a continuation of the trend. What we're basically seeing is, week sales. As everybody knows, in March we had the fewest home sales for that month since 1986. So 33-year low, and that seems to be continuing at least through the first couple of weeks here in April. I mean, we do have a bit of a seasonal uptick in terms of April tends to be one of the busiest months, I guess, for the real estate seasonal cycle. So we do have a little bit of uptick in sales. So I guess you could say on a month-over-month basis, we'll see an uptick from March, but that's pretty normal. What I usually like to compare it as is year-over-year comparisons for the exact month of April, and that looks like it should come in near record lows once again.
Are people waiting for prices to come down, or do they fear interest rates still might go up?
No, I mean, obviously, as we've seen the mortgage rates come off a little bit. So I think that sort of eliminated some of those fears. And I think a lot of that, consensus that was calling for, higher mortgage rates to offset any decline in home prices. Thus, you should jump into the housing market immediately and buy right away. As we can see, that consensus has not come to fruition. I think that we've seen growth start to slow down, and that's certainly what the bond market is suggesting. So that's lowered some of the mortgage costs there. And it's still really just a fear of sort of jumping in too soon. I think everybody's a little bit too cautious on the housing market in terms of, when to pull the trigger. 33-year low in sales has certainly pushed a lot of people to the sidelines and worrying about buying in too soon.
Is this a case of a lot of homeowners are reluctant to bring their prices down to meet the demand of the market? Yeah,
that's generally when you get housing downturns, these tend to be a lot more prolonged than most people expect or anticipate, and that's primarily just because you get stuck in this low sales environment, and it's really just ultimately just what the buyers are willing to pay, and it's a disconnect between what they're willing to pay and what the sellers are willing to sell at. So you basically have this disconnect, and it takes a lot of time for sellers to emotionally adjust to reality in terms of what people are willing to pay. Everybody always looks at peak valuations, maybe what their neighbor got a year or a year and a half ago, and everybody always can come up with a justification as to why their home is more special than the neighbors, or why it should garner a higher bid. And but ultimately, the market is the market. They'll ultimately dictate the prices, and so it's really just emotionally getting the sellers to slowly adjust. And so what you tend to see is over time they slowly adjust their sales prices lower. It could be $100,000 cut 1 month, and then 2 months later you get another $100,000 slowly to get them down to where they need to be in terms of actually getting the product sold.
Now, of course, depending on when you bought your home, you could still make a tidy profit after dropping your price.
Yeah, exactly. I think, I still see it too. Like, you see people that bought 20, 30 years ago that are still emotionally tied to some sort of pie-in-the-sky price that just isn't realistic in today's environment. But, they look at it and say everybody's always trying to maximize, their value, their profit. And like I said, it's such an emotional process, right? You're not talking about, a stock, right? You're not talking about somebody's stock in Apple that, they're not emotionally tied to. It's when you're talking about real estate, a home that somebody's lived in for 20, 30 years and built a lot of memories there. There's so much emotions tied to it. And so that's why it's hard to get the prices down.
Also, when somebody has their home up for sale and expects to get what their neighbor got, what if their neighbor had put on a new roof, installed new appliances, put in a new floor, put in a heat pump, did things like that? So on the outside, it looks the same, but it's not the same on the inside. So their home's more valuable.
Yeah, that's part of the thing too. I think it's just really tough, for housing. It's the price discovery is very, very difficult, specifically for detached houses, right? I mean, every house is so unique. You can be on a corner lot, you might have a view, might have an updated kitchen, different layouts. So it's really hard to pinpoint exact valuations, right? I mean, we say, typically in some of these detached housing markets, you're seeing prices down as much as, 30, 35% in some segments of the market, but, you could see other parts of the detached housing segment that are only down maybe 15%. And a lot of that just comes down to different qualities, different specifics on an individual house. So it's so unique, and the price discovery, specifically in a down market when there's record low sales volume, it's very hard to figure out what prices are worth.
We'll have more with Steve Saretsky right after this.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO, on the TSX Venture Exchange. Rainy Mountain Royalty Corp. is a Canadian-based mineral exploration project generator. The company currently holds multiple property interests in Ontario with joint venture partners and is seeking further joint venture partners for other drill-ready properties in our portfolio. For more information, please visit our website at rmroyalty.com or call me at 604-922-2030.
Cypress Development Corp's flagship lithium project is located just east of Albemarle's Silver Peak mine in the heart of Clayton Valley, Nevada. A 12-hole exploration drill program for lithium-enriched claystone on Cypress's 100% controlled properties is now underway. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the Pink's CYDVF, and on Frankfurt's C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Welcome back. We're speaking with Steve Saretsky. Steve, are building permits a barometer of developer confidence in the housing market?
Yeah, I look at building permits are generally considered, amongst people in the finance space and in the economic space, is that, building permits tend to be a leading indicator of, future economic growth. Obviously, the real estate and construction sector makes up such a large portion, of the economy, particularly in places like BC. So, basically, it's just a leading indicator of developers' future intentions to build new product, and obviously that basically is a leading indicator for construction jobs and wage inflation in the construction space as well. So what we're seeing right now is the building permits have dropped off significantly in the single-family housing market. They peaked, actually, the value of building permits in Vancouver peaked in 2016, which is pretty much dead spot on with the peak in price of the detached housing market. And now we've seen those single-family building permits drop off significantly. They're still very elevated in the multifamily segment in terms of, pre-sale condos and whatnot. In terms of that aspect, what I'm basically seeing sort of more of a feet in the ground, and also anecdotally speaking with a lot of developers, is that a lot of them are rushing to get their shovel in the ground, get things rolling. Obviously, if you bought a parcel of land, you're seeing the cycle roll over and come to an end. You want to get your shovel in the ground and get the project moving, so you can get it to market, as opposed to, potentially, if you miss the cycle completely, then you're stuck holding land for who knows how long, waiting for the next cycle to pick up again.
If there's a drop in housing construction, is that eventually going to lead to another shortage?
That's typically that's generally what starts the next cycle, right? I mean, generally speaking, is you get the run up. So, developers react to the increase in prices and the increase in demand, and through that they start building more and more housing. And generally, as the housing market starts to slow down, you're left with less demand and oversupply of housing, and that pushes prices down. And so as a result of that, banks stop lending and developers pull back on building new homes, and then that over time starts to create a shortage of homes once again, and eventually the demand, once the economy stabilizes, starts to pick up again, and that sort of starts off your next cycle, your next up cycle. So it's really just a typical pattern that, it happens every 8 to 10 years, like pretty much like clockwork. So
is the presale condo market going through a boom-bust cycle?
Yeah, I mean, it certainly is going through a typical cycle. It's certainly going through a normal pattern here, where I think, as you can see, that we had record low condos for sale, a year and a half ago, and now we're starting to climb. We're seeing inventory in the condo segment double on a year-over-year basis, and then you still have record number of new construction units coming at a time when the demand has fallen off quite significantly, and inventory is increasing. So, that's definitely a pattern of a real estate cycle. And will this one be more exacerbated than the last? It's certainly a realistic possibility, given the credit background that Canada's faced with record indebtedness and really not much room to drop interest rates. So that could certainly exacerbate things potentially a little bit more.
Is buying a presale condo like buying a stock on margin?
Yeah, I mean, I look at it as pretty much like a futures contract, right? And you're basically locking in a price today at a future valuation that basically is an unfinished product, right? So it really is basically just a future claim on a condo, and so essentially, it's essentially a futures contract.
Who's likely to be left holding the bag in the presale condo market?
I mean, generally speaking, it's kind of the last guy holding the contract. Obviously, we'll have to see how that presale market shapes up. I think that it's certainly been built on a lot of optimism and a lot of speculation in terms of the prices continue to rise. So what we saw was developers were basically marking up the prices on these presale condos. So, you might buy into a completed unit today for $1,000 a foot, but at the peak of the market, the developers started charging, $1,200 a foot. And, with the expectation that in 2 years' time, when the condo was completed, that's where the market would be. And obviously, that's not what we're seeing today. We're seeing the prices actually decline. So, it's certainly going to create potentially some issues, at the closing time, when these guys have to get a mortgage from the bank, and the bank goes to appraise the unit and says, hey, it's not worth what you paid. So here's your mortgage, and good luck with coming up with the shortfall there. So I think, unfortunately, a lot of buyers that go into these pre-sales, they don't understand the risks involved. A lot of the times they don't have representation from a realtor. They go in and buy directly from the developer at the pre-sale center, and really aren't aware of the risks involved. And especially as a buyer, you're taking on more risk in that process. So certainly you should be compensated for taking on that risk. But as we just discussed, they weren't being compensated. They're actually paying more for that risk, which is great.
Or you may end up signing a contract that is loaded up for the other side and nothing for you.
Yeah, exactly. And almost all the developers will have their own pre-written contracts done up by their own lawyers, right? So that's really, for the most part, in the benefit of the developer, not in the benefit of the buyer.
We'll have more from Steve Saretsky right after this.
Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. Work programs are underway in Finland and Canada. Arctic Star trades on the TSX Venture Exchange symbol ADD, on Frankfurt symbol 82A1, and the OTCQB symbol ASDZF. Please visit our website arcticstar.ca or call us at 604-689-1799.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Steve Saretsky. Steve, are home buyers in Vancouver now at risk of so-called catching a falling knife?
Yeah, I don't know. I mean, it's hard for me to say, obviously, in terms of like where the market goes. But certainly the analogy that's being put out there in terms of, hey, you know, prices are falling. How much further could they fall? Is now the right time to be jumping into the market? It's really kind of just depends on your view and your long-term thesis on the market. You know, I look at houses in West Vancouver; they're down 35, close to 40%. You know, like, what is the bottom? Is it another 10, 15, 20%? Who knows? It could certainly potentially be that. But yeah, I mean, I don't know. In terms of timing the bottom, that's obviously pretty hard to do. I always like to go back and look at the States. Obviously, they're very different markets, but they've just went through, you know, a generational housing bust just 10 years ago. So I think it would certainly take a lot of knowledge away from that scenario. And I think I look at that one and I say, you know, hey, if you bought in 2006, 2007, well, yeah, you know, you probably didn't do very well. But if you bought in 2008 or 2009, you know, you're obviously, for the most part, you're likely going to be up today, even though the prices actually kept declining for another 3 or 4 years. Actually, prices ended up bottoming in 2012 officially. So, yeah, in terms of timing the bottom, very, very difficult to do, of course. But there certainly could be more downside in Vancouver, and right now there looks to be more downwards pressure on the prices.
Did a lot of people have the attitude that Vancouver real estate was bulletproof?
Yeah, I think that, you know, it's been over a 20-year, it's been almost a 30-year bull market, right? I mean, as I like to say, you know, certainly speaking with a lot of developers and people in the industry, that, you know, everybody's made a lot of money here in the last 20 years specifically. But the reality is nobody in the last 20 years has really seen any sort of down market, any real pressure. You had a bit of a liquidity crunch for about 8 or 9 months in 2008. But it really wasn't a real housing downturn. You know, you saw prices drop off 12, 15%. It was really again, a sharp liquidity drain, for a short period of duration. So I think it's kind of created a bit of a false safety net in terms of, what a real housing correction looks like. And I think you're starting to see that in the detached housing space, you know, where you know, that market's been correcting now for quote 2 years. And, you know, so I think that's, you know, if you want to look at what's a real housing downturn, just ask the people in the U.S. and Spain and Ireland, that just experienced it 10 years ago. And I think they'll have a much different, you know, outlook of what potential downside can be. So I think for me, that is a bit of a concern. Just, you know, having 20 really, really good years here in Vancouver, that, it creates a perception that the investment is, you know, risk-free. And of course, there's no investment in the world that's risk-free. And, you know, 20% annual returns on Vancouver real estate, are simply not normal. You know, those kind of returns make Warren Buffett look average.
For Vancouver real estate, what's the mood on the street?
Yeah, I mean, I think it's definitely more negative, more pessimistic. I mean, obviously when the media reports, fewest home sales since 1986, I mean, I think that certainly starts to weigh on psyche. So, I think that people are definitely more negative, definitely more pessimistic. As we know, a lot of the buyers have shifted to the sidelines. They're a little bit nervous about putting an offer on paper. And, I think a lot of sellers are still cautiously optimistic. Not really seeing too many fire sales or panic. Hey, I need to get out. I think people are quite optimistic, or, you know, that the Vancouver market will be resilient and you know, will bounce back anytime soon. But, yeah, so it'll be interesting to see how the behavior shapes up, because that's ultimately what moves markets.
Steve, thank you so much for being on the show.
Always a pleasure, Jim. Thanks a lot.
My guest has been Steve Saretsky, a Vancouver-based realtor. Find him online at stevesaretsky.com. If you have any questions for Steve or any of our other guests, you can send them to info@housestreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.